Hello class, this is Dr. Fenton. In this video, we're going to talk about financial statement fraud. Now, like I've said before, don't use these PowerPoint slides here. I'm not talking about them as a substitute for reading the chapter. Please go back and read the chapter in a lot of detail. There's a lot more information there. In these videos, I'm just covering the highlights of the chapter, but there's a lot of detail you need to read for yourself. Let's get started. Okay, so financial statement fraud. It's a big area. We're talking about hundreds of millions of dollars, sometimes per loss, per fraud. It could be billions of dollars. So it's a big deal when it happens. And this is where companies are misrepresenting the financial position of the company. They almost always try to make the revenues look higher than they should be, which leads down to net income. The assets are higher. And so they do this for a variety of reasons. Maybe the CEO or the CFO themselves are trying to keep their jobs. So they want to, make the statements look good, make it look like they're doing a good job, and so if it looks good, maybe they can keep their job. So again, various reasons. Another reason could be the company's getting ready to issue some bonds. So they might be trying to borrow, tens of millions or $100 million of bonds. They want a lower interest rate. So if their numbers look better in the financial statements, maybe their rate will be lower. So again, various reasons to commit fraud. Let me remove my video and go to the other slides. So here we go. A little background. PwC did a global economic crime survey, and this is for fraud in general, not just financial statement fraud, but just in general, 46% of fraudsters were internal actors. Now, if you looked at just financial statement fraud, this percent would be a lot higher, but this is total fraud. So you do have some external sources as well. Top industries were financial services. Okay, we can sort of see that. And this next one might surprise you. Government, state, and state-owned organizations. There is a lot of fraud going on in state and local governments. It happens frequently. You read about it in the newspaper almost all the time. And then you can see that cybercrime jumped into second place behind asset misappropriation. And you know what cybercrime is, stealing from the company in various ways. It could be credit card fraud and so forth. Now, asset misappropriation, that's a fancy way of saying someone's stealing your cash. Someone is stealing your inventory, or maybe some of your fixed assets. So that's what asset misappropriation is. Now for compliance spending, this is very interesting. If companies would spend $1 on compliance, which means setting up internal controls, making sure they work, review them, and redesign the controls if needed, so $1 of compliance would save the company more than 5 times that number. So on average, it would save them $5.21 in the heightened avoidance of legal liabilities, harm to the organization's reputation, and lost productivity. So $1 spending and trying to prevent fraud hopefully would save $5, more than $5 in what might happen if you have fraud in your corporation. This shows you that when you're really looking at anything, especially when you're in a fraud examination or a regular financial statement fraud, look for the small things. Look for just very, very detailed things. Here we have a former Scotland Yard scientist. He tried to create, fraudulently, $2.5 trillion worth of fake U.S. Treasury bonds. $2.5 trillion. Now, 2 men had these, some of these in Toronto. They had 25 million of these, and they were trying to, sell these. Well, a Canadian Mountie noticed the bonds bore the word dollar rather than the plural dollars. So that one letter difference triggered the Mountie to thinking these could be fraud, fraudulent bonds. They were. They went back to a London bank vault that had some of these, reviewed these, and found out that these fraudulent treasury bonds had been printed with an inkjet printer that was not even in existence when these bonds really should have been produced originally, if they had been real bonds. So little things like this, the type of printer, sometimes even the ink being used. And here a Mountie saw that it was the word dollar instead of dollars when I mentioned 25 million. So small things like this could be the one clue that you have to spot fraud. Here are the 3 M's of financial reporting fraud. And it starts off with manipulation, and it continues with falsification, alteration. You're talking about accounting records. You're talking about supporting documents. Okay? Misrepresentation. Maybe you are intentionally omitting something. Maybe false transactions, other information, and so forth. And so you're misrepresenting something that leads to, again, numbers that are not accurate in the statements. And then a third one could be intentional misapplication of accounting principles related to amounts, classification, manner of presentation, or disclosure. And disclosure, as you probably know, would be things that would be included in the notes to the financial statements. The type of accounting method you're using, or different information items about your company. So these are the 3 M's. So this is what's going on out there, and it can happen. Next slide here. Now the SEC found various schemes that were involved in financial reporting fraud. And we're looking at fictitious and or overstated revenues and assets. This happens, I almost want to say all the time. I mean, you hear about it so much. But overstating those revenues and overstating assets, this is one of the main reasons why we have fraud. People are doing this intentionally. Look at the next one, reduction of expenses and liabilities. This is the opposite side. So you're not trying to inflate revenues or assets. Here you're trying to lower expenses. Has the same effect on the income statement as inflated revenue. So you're trying to get net income to look higher. Liabilities, sometimes you want the debt not to appear as large as it actually is, because maybe you're trying to acquire more debt, and so you're trying to somehow move the debt off the balance sheet through various reasons. Again, 3 sort of relates to number 1 in a way. You're trying to take revenue that would have been earned in the future and bring it into the current year. So you are overstating the current year's revenues. That means for this particular one item, you would understate next year's revenues. But the train of thought here is, I don't care about next year yet. I want this year to look better. Let's just get past this year. I'll worry about next year when I get to next year. And then 4 and 5 sort of relate to each other, misclassifying revenues and assets, and that could lead to overvalued assets or expenses and so forth, undervalued. An example here would be you have an expense and you decide you don't want it this year. So you fraudulently, again, this is illegal, so you don't do it, but what has been done, people will record this as an asset. So you're moving the debit from an expense to an asset. Not recording the expense, of course, increases net income. So the right side of the balance sheet, the retained earnings, looks good. How does the left side balance? You've put that number in as an asset. So the balance sheet still looks good. At first glance, everything balances, looks fine, but really we have fraudulent numbers in here, and if it's not caught soon enough, then people could rely on this information, and then they could lose money because of these fraudulent statements. Here are some more. You can look at these yourself. The last one there talks about the reverse. Maybe someone's trying to lower income tax liability. So they might try to minimize revenue, inflate expenses. So that's like some income tax fraud, number 11. How do they do this? Similar to what we just talked about. Record revenue before it's earned. As an auditor years ago, we had to look and make sure that if the company had a December 31st year end, that sales made into the new year in January were not recorded back in December. So you look for any kind of backdating of revenue to get next year's revenue into the year that just ended. Fictitious revenue, just creating transactions here. You're trying to boost profits with non-recurring transactions. This could be where you are selling some of your assets. You decide, well, this quarter or this year, I really need some more net income. And so I'm going to sell an asset, report the gain. That'll hit the bottom line as net income. And you can read the others yourself, again talking about income, expenses, and liabilities. This slide shows, let me show you with this, internal fraud. The employees, these are what employees will do. I wanted to demonstrate, don't look across here. We're not trying to say stock theft is the same as lapping, is the same as check forgery. Just take it one column at a time here. So employees, we'll talk about employees more in the next chapter, but employees, stock theft will be inventory. Okay, so you're walking out with inventory, or they take cash. Now lapping you see in two categories, one under employees and one under management. Lapping is where you might receive money for an account receivable, but you might put that money in your pocket and not credit the account receivable. Now someone else later on pays you some money for their account receivable. You take that second person's money and apply it towards the person you stole from. And then when the third one comes in, you take that money, apply it to the second one. So that's called lapping like that. So you're stealing money along the way, and you're not recording accounts receivable being paid off when they're actually happening. And you can look at the others. Management gets into lapping, expense accounts, false financial statements. That's what we're talking about in the chapter mainly. And external, we'll talk about that later on in another chapter, but you can see those. Check forgery, false insurance claims, and credit card fraud. These are some more. I'll let you read through these. These are in your chapter as well. Internal controls. This is what companies use to hopefully prevent fraud. Not only prevent fraud, but to make sure that we're going to try to prevent errors as well. So you look at your entire environment. What needs to be controlled? Of course, anything going into the accounting records need to be controlled. Any assets you have to protect those. Protect your inventory, protect your fixed assets so they're not stolen or destroyed or whatever. Second point, risk assessment. Now you look at your various transactions, the activities in the corporation, and try to decide where are our risk. And then go to number 3. Once you find risk, number 3, then you come up with the procedures and activities to hopefully prevent or lower errors, lower fraud, hopefully prevent fraud. But these will be the actual internal controls. Once you've gone through the first 2, then you start setting up controls people need to follow to help protect your assets and to protect the validity of the financial statements. Your communication systems are important, and then you have to monitor everything you've set up. Now we have 3 different types of controls. So I'm going to flip through 3 slides real quick. Here's number 1, preventive controls. Here's number 2, detective controls. Here's number 3, corrective controls. Let's go back to the first one. These will be procedures you design to, again, help prevent fraud and also help prevent errors. And hopefully you'll have, more accurate records, financial statement records with these controls. So you want to segregate duties. So for example, if you had a company where one employee could accept customers' checks either through the mail or walking in, and they could make entries into the accounting records, and they made the bank deposits, daily or whenever, and if they reconciled the bank statements when they came in, if they had all those duties under their control, that one person's control, this is just open for fraud. It'd be easy for them to steal some of the cash, cover it up with fake journal entries. They had the bank statements. If they're reconciling the bank statements, they can make it look like everything was okay. So you're trying to separate that out. And of course, small corporations, small businesses don't have the luxury of having extra people to separate these duties. Larger ones hopefully will. But that's the segregation of duties. You need to make sure any kind of purchase, any kind of payment is required. That's the second one. Securing assets. Again, protect your inventory, protect your long-term assets. Use passwords, and you can go on through the rest of these. These are preventive controls. You're trying to prevent fraud. You're trying to prevent errors getting into the financial statements. Detective controls. These come into play as a way to check on or to monitor the first set of controls that you placed in. Let me go back up a slide. You're going to hopefully prevent them here. The second one here, let's look at those preventive controls and see if they're working. So you have reconciliations. You review the systems. You see if anything happens, were the correct people notified. Let's do some surprise cash accounts, surprise inventory accounts. Trying to make sure that are the controls working. So these are detective controls. You're looking for something. Are things going okay, or are there changes that need to be made? Were there mistakes made? Was fraud going on? And finally, the corrective controls, if you have problems, maybe you need more training. Maybe, and number two, you need to redesign one or two or more of the processes. Let's add more technology and so forth. So those are three type of controls. Make sure you know those. Again, preventive, detective, and corrective. Earnings management. You hear this term a lot in the financial world, and we define it here as purposeful intervention in the external financial reporting process with the intention of obtaining some private gain. This could be upper management, again, trying to change the numbers, make the numbers look better. Their own private gain would be getting a raise, keeping their job. Okay. Earnings management. And we're going to see in a minute, it could be legal earnings management or it could be illegal. Okay, so you have some opportunities there. Why would people want to do this? Well, the first one, 59% say that they felt pressure to do whatever it takes to meet the business targets, to meet the numbers. If you're expected to have a certain earnings per share in the quarter that's getting ready to end, and you see you're not hitting that, you might feel pressure to change journal entries, falsify data, or whatever to hit that target. Some people, number two, believe that they'll be rewarded for the results, not the means it took to get those results. So they think that whoever's going to reward me, like, again, a raise or something, or even keeping the job, they're going to look at the bottom line. They're going to look at net income, not how I got net income, but what does net income say? And again, you can look at the others, code of conduct not taken seriously, and standards for jobs and so forth. So look at that. And frauds, fatal failings. This is not good. 85% of fraud victims never get their money back or the property. So when there's fraud involved, it is gone. 85%. Most investigations flounder. In other words, they're not finished for some reason, or there's not a good job, leaving the victims to defend for themselves against counterattacks by hostile parties. What does this mean? Well, it could be one of your suppliers or maybe one of your customers was defrauded by one of your employees. If you don't do a good job of finding out what happened and taking care of that, and possibly, even though it's hard to do, making the employee pay back what was stolen or whatever, those other parties might come back and sue you. So you don't want that to happen. That last one, look at this number. 30% of companies that fail do so because of fraud. So almost 1/3 of companies that fail do so because of fraud. A huge number. So fraud is extremely important. It has these devastating consequences. So you're trying to prevent this fraud. If you're called in on a financial statement audit and looks like there's fraud involved, it might turn into a fraud investigation. And if you're involved in that, the fraud investigation, then again, you're trying to figure out what happened so it will not happen again. And hopefully it was caught early enough so the company would not fail. So just devastating consequences when fraud is involved. We saw the COSO group in a previous chapter, and they're just saying here that companies of all sizes are hit with fraud, from very small companies to the large international companies. The median company has just under $100 million in revenues and assets. the median fraud was $12.1 million. And more than 30 fraud cases each involved more than $500 million. Who is doing this? Well, the SEC said that the Chief Executive Officer and/or the Chief Financial Officer were involved in 89% of fraud cases. 89%. So we're talking about the upper levels of management. Motivations, again, we talked about this. They want to hide bad financial conditions and so forth. Maybe you're preparing for more debt or equity to be sold, and so you're trying to make the numbers look better. Talking about revenue again, big area, 60%, those cases. Overstated assets, 51%. Now, this is the famous fraud triangle, and if an employee in the business has each of these points covered, then that makes it a stronger possibility that fraud will be committed. Let's look at the top one, incentives, pressures. Let's say that one of the top management, like CEO, CFO we just saw, they are under pressure to hit the numbers. They might fake some entries or whatever to make the income look better in a quarter or in a year. This could be an employee down the line somewhere who has pressures. Maybe they have a gambling habit, and so they need a lot of money to cover their gambling debts. That's a pressure. Let's move down to the right. Opportunity. If someone's in the position to steal cash, to make entries into the records to make the statements look better, that's the opportunity. Can they do this? Can they cover it up? Can they do this without someone finding it? That's the opportunity. So that's the second point. Let's move over to the left. Attitude, rationalization. Here's where they finally start thinking, this is okay to do. It's okay for me to commit fraud. Their attitude might be, well, I'm not hurting anybody, I'm just hurting the company. And the company's big enough where they won't notice. Or maybe the company owes me this, I'm underpaid. So they have the pressure, they have the opportunity, and they feel like they're not being paid enough. They're just going to try to take some cash or take some assets. This is the fraud triangle. It's been around for a long time. Here we have the fraud diamond, and the top and bottom and right were taken from the fraud triangle, and then the one on the left, capacity, came in on this one. Capacity means, does that person have the traits to do this, the ability? Can they pull it off? Do they have the position of authority to do this? So I know it sounds like it sort of commingles with some of the others, and it might, but one person or these authors identified that fourth point here. So make sure you know the fraud pyramid and the fraud diamond. What this all boils down to is that financial statement fraud is prevalent, but just because you have earnings management doesn't mean it's abusive enough to be illegal and therefore fraudulent. Now, earnings management, when you think of that, companies have various choices they can make in accounting procedures or accounting rules that they can choose from. That's fine. They can do that. But when it gets to be abusive, that's where it's illegal, and that's where it's fraudulent, and that's where it can hurt other companies and other people. So there's a thin line there, between the criminal behavior and merely conduct that's beneficial to the organization. It's okay to make decisions that benefit the corporation. They just cannot be criminal, in other words, illegal or fraudulent. So that's it. I know it's sort of a long video, but hopefully you gained something from this. So again, hopefully you learned a lot about financial statement reporting. And so, as always, good luck with your studies.